Hey everyone, thanks for joining this month's Money Matters with FSA. I'm Mike Zarelli, certified financial planner, and today we're going to talk about the key data points you should pay attention to from your tax return. We did it, we made it through the 2024 tax filing season, unless you filed for an extension. Now's the time to take a look at your 1040, the summary page that you probably received from either TurboTax or your CPA, and understand what actually happened. How did your 2024 tax picture actually end up? With that, let's dive right in. First up, I've got a sample summary page from TurboTax. Again, your CPA may provide a cover page or a document very similar to this. And it's really nice because it gives you some of those key points right off the bat to really understand your full tax picture for the tax year. First up is going to be your adjusted gross income, AGI for short. And this is going to be the total amount of income that you had throughout the year. For this client, this fake client, it is $225,500. Now, as most of us know, that is not all taxable. You've got the standard deduction, you've got other credits, tax credits that reduce that adjusted gross income to what's next, the taxable income. And in this client's case, they had $194,000 of taxable income. So that's the amount that they're actually going to pay taxes on. Next up, we've got to understand the marginal federal tax rate we paid and then the effective tax rate we paid. To illustrate this, I'm going to show you a graphic that demonstrates how the US tax system works. It's a progressive tax system, meaning not every single dollar is taxed at the same rate. So for example, I'm going to just draw a little bit here. If you had $194,000 of taxable income, that would put you in the 22% tax bracket, in between 200,000 right here and in between 94,000. But that does not mean all $194,000 will be taxed at that 22% tax rate. Instead, you have some money taxed down here, some money taxed in the 12%, and then anything above 94,000 gets taxed at the 22%. And so while this client is in the 22% marginal tax rate, when I go back to their summary page, so there, they have an effective tax rate of 14%. Now, some may ask, how do they calculate your effective rate? And it's actually a pretty easy equation. And in TurboTax, what they do is they take this dollar amount, the amount of tax paid, so 32,000, and divide that by your adjusted gross income. So $32,000 divided by $225,500, that gets you your 14% effective tax rate. Next up, we're going to want to talk about what type of deductions you took. And typically there are two broad types that you want to understand. First up is the standard deduction. So anybody can take the standard deduction, or an itemized deduction, meaning you added up all of the mortgage interest you paid, the state taxes, health insurance, Medicare, medical costs, et cetera, et cetera. And if that was higher than your standard deduction, you may be able to itemize deductions. Now, where can we find that? We would have to go over to your 1040. Now, this is just a blank 1040 US individual tax return right here from the IRS. For the average person, this is a lot going on here, so I'm going to break it down to just what do you need to pay attention to. Again, that's why you hire professionals. They see these every single day, but I'll dive right in. So first page is going to be a lot of just information, your home address, social security numbers, etc. Then we get down to the first part, which is your income. From here, we're going to have to pay attention to a couple of items. So first up, I'm going to keep scrolling down, is did you get the standard or itemized deduction? That can be found on line 12 right here. So standard deduction or itemized deduction. Now in 2024, for a married filing jointly couple, the standard deduction was $29,200. So if you see a very nice even number like $29,200, A lot of times you took the standard deduction. Now, if you itemize deductions, one, it has to be higher than that threshold. And then two, it may be a little bit of an odd number. Maybe it was $31,230, something a little less clean. That would indicate to me that maybe you itemize deductions. Now, another key point here is that if you're not sure about if you itemized or took the standard, you can always look at Schedule A right here. Schedule A is where you itemize those deductions. You list out the mortgage interest, the state taxes, and anything else that you can deduct. It'll be totaled at the end, and if that total is higher than that standard deduction, well then, hey, you itemize your deductions. That wraps up the key, like obvious items that most folks will have. Everybody will have a marginal rate, an effective rate, AGI, and taxable income. Now I'm going to dive into some of the tax strategies that we implement with clients and where they're going to show up on the tax return. The first item we're going to talk about is what's called a QCD, Qualified Charitable Distribution. This is a distribution that comes from your IRA. Now you have to be older than 70.5 to do this, but it's a distribution that comes directly out of your IRA and is not taxable because it's a check being made out to a charitable entity, a 501c3 entity. So this is going to show up on line 4A, IRA distributions. This person, they may have had $75,000 coming out of their IRA distributions. Not all of that is taxable. Maybe they did a QCD. And what you would see is on line 4B is that not all $75,000 of the distributions would be taxable. Only $50,000 would be taxable. Now, what this means is that the QCD amount is excluded from your income. A lot of times what you'll see, or how this should be done, is in the margins, your tax preparer or TurboTax should put QCD right in this margin right there. That's how you know that you didn't get taxed on that income that went directly to a charity. Okay, now we're done with the 1040. Next, I want to look at a different form that honestly not many people are aware of. It is called Form 8606, non-deductible IRAs. I'll zoom in and get this zoomed in. And this form comes into play when you've either done a non-deductible IRA contribution, meaning you did not get a tax deduction on that IRA contribution, or you did a backdoor Roth contribution, or you did a Roth conversion. Again, these are all strategies that FSA Wealth Partners helps our clients implement when it makes sense. And it's crucial to have Form 8606 filled out if you implement any of these strategies. The first part is going to be the non-deductible contributions to IRAs. Now, when would this make sense? Well, first off, if you make too much income, the IRS says you do not get a tax deduction for contributing to your traditional IRA. You make too much money, you have a 401k at work, that's how you're going to get your tax deduction. We're not going to allow you this deduction on the traditional IRA. That makes sense for some folks to still make a non-deductible IRA contribution. And the reason you can, or the reason you want to fill this out, is because you've already paid taxes on this money because you're not getting that tax deduction. Form 8606 allows you to keep track of how much money that you put into the IRA. That way you're not double taxed when you eventually take out the money. So let's say I'm just going to draw over here. Let's say in 2022, you made the max contribution, $6,500, did not get a deduction for that. In 2023, you did another $6,500. And then 2024, you made a $7,000. It increased a bit, the max contribution. You made a $7,000 contribution. Well, now we've got $20,000 of basis in your IRA. So when you take that money out, that should not be taxed again. Now, it's going to be taxed at a pro rata basis, video for another day. But either way, we do not want you paying Uncle Sam any more money than you have to. That's why filling out Form 8606 is crucial if you make a non-deductible IRA contribution. Next, we're going to look at where to enter Roth conversion. That is going to be down here on part 2, 2024 Roth conversions from traditional SEP IRAs, simple IRAs, regular IRAs, et cetera, et cetera. So this part is filled out when you have an IRA. Draw up here again. You have a traditional IRA. You've never paid taxes on this money, but you're in a low tax bracket. So we decide, let's take the money out, pay the taxes here, and convert it to a Roth IRA, this Roth bucket, so that way it can grow tax-free for the rest of your life. This is a strategy we use a lot of times when folks have less income, they're in a lower tax bracket, maybe they retired early and they haven't taken Social Security or started required minimum distributions yet. Yeah, so it's important to make sure that this 8606 is filled out for Roth conversions. One, you're going to enter an IRA distribution from your 1099-R that you should receive from this IRA over here. And then second, the IRS wants to keep track of your Roth basis. Taking money out of the Roth IRA after you reach 59.5 is going to be tax-free. Important to keep track of what contributions have gone in there, just in case the IRS asks, how did you fund this Roth IRA? All right, lastly, we're going to talk about the backdoor Roth IRA. And I saved this for last because it's a two-step process. Up first, we have to do a non-deductible IRA contribution. So you do a non-deductible IRA contribution. You never get the tax deduction, which needs to be filled out in the part 1. For example, you contributed $7,000 non-deductible to your traditional IRA. And let's say this traditional IRA is empty. There's nothing else in there. And typically that's what we want. The IRS needs to know that you didn't take a tax deduction there. And then you're going to convert it over to your Roth IRA. Because you never took a tax deduction, that contribution or that conversion to the Roth is not going to be taxable. And that's why it's so crucial to fill out 1, this part 1, and then 2, part 2 of the Roth conversion. And if this is done correctly, this should not impact how much you owe in taxes for the year. It's a two-step process. If you don't know what you're doing, please see professional help, a tax preparer. Make sure that you tell them I did a backdoor Roth IRA. For our clients, we send out a tax letter that they can give to their tax preparer to make sure that they're entering these tax planning strategies correctly. Because if it's implemented but not implemented correctly on the tax return, in the IRS's eyes, the transaction did not happen. Wraps up this tax video. I know we went through a lot of different forms, a lot of different key items to pay attention to. As financial advisors, we help our clients review their tax returns, make sure that there's no mistakes, or see if there's any other tax planning strategies we can implement for them. So that way they can enjoy their wealth today and tomorrow. I'm Mike Zarelli, certified financial planner. Thanks again for watching this Money Matters with FSA video. I will catch you in the next episode.